Okay, guys, we're going to go ahead and get started. Game plan for today is to get through Chapter 12 and potentially take a look at some things from Chapter 13 if we have time. If we don't, we should be okay on time because Chapter 13 is fairly short, so we'll get to it on Wednesday. But as you can see, we're about a day behind, but I think we'll be okay to go ahead and cover everything as we wind things down, right? We've got this week and next week, and don't forget that we will need everything turned in by a week from this coming Friday. So make sure you're keeping track of that date. That's the 15th, okay, and everything needs to be in. So make sure that I'm sure by now you've picked your company and started to take a look at some things. Somebody had asked me, well, can I write the paper where I'm simply adding sections or having sections that will respond to each of the rubric elements? And that's fine if you want to put, like a dark, bold heading that says whatever the rubric is saying. So let me say it a little more generally. The closer you can tie your paper to the way the rubric is asking and making it easy for us to see that you address the rubric elements, the better. I think that's probably the way to think about that. Any questions on any of that? No? Okay. Then if there are no questions, we're going to go ahead and jump into Chapter 12. And we're going to start dealing with a new statement that we haven't talked about previously. So we had talked about, where's my slideshow? Right here. Okay, because we've been talking about the income statement. First you prepare the income statement, then you prepare the statement of retained earnings, then the balance sheet, right? And we kept saying that the statement of cash flows we'd get to later, and so here it is. Now, statement of cash flows is unique because what we do is we take the balance sheet and the income statement and we analyze those two statements in conjunction with each other, and we prepare the statement of cash flows. So it's almost like the statement of cash flows is the child, if you will, of the income statement and the balance sheet. So there are no journal entries that need to be made to generate a statement of cash flows. It is simply what? We make the journal entries so that we can prepare the income statement and the balance sheet, but then once we have those two statements, we can prepare the statement of cash flows. Okay? So what I'm going to do is go through a few basic things, takeaways about this statement of cash flows. Then I'm going to ask the folks in the control room here to go ahead, lift the screen, and I'm going to be writing quite a bit on the board. So this is one of the few times that you're really going to have to kind of watch when I'm writing on the board and see that you're understanding that as we go through the little sort of example that I'll do. Okay? All right, good. First off, what is the usefulness of this statement of cash flows, okay? And what we're really trying to understand, is the entity going to have sufficient cash to be able to operate? Are they going to have sufficient cash to pay, say, dividends, or if they need to purchase equipment or something? Will they have the cash resources that they need, okay? Now, another significant objective of preparing the statement of cash flows is so that users, remember our users of the financial statements, can understand the difference between net income and cash provided by operations. Okay, so that's really sort of a big one that we're going to be looking at. Now, when you look at the statement of cash flows, there are three sections to it. There's the operating section, investing section, and the financing section. Okay. And I'm going to talk about each of these, and I kind of teach the statement of cash flows backwards, and that most folks will start with the operating section because FASB tells us that's the first section we should see. But I have found that it's easier for folks that are new to the statement of cash flows to understand it if we build it from the last section, the financing section, and then talk about the operating section. So that's the direction that we will go in, okay? Now, let's go ahead And let's talk about then that financing section first. And I guess maybe someday I should change the order of these slides. But the financing section, okay, what kind of activity on the statement of cash flows will show in the financing section? So let's say you have a company and you want to finance a project. Okay, this would be a good time to pay attention to what I'm saying, not to who's arriving and sitting next to you in your row. Okay, you have a financing need. You're going to buy some equipment and you want to get financing for that. What would you, let's say you have a financing expert or financing department, what would you tell that department to do? You need some money in your corporation to finance some activity, whatever it is. What would you tell them to do?
Find a good rate.
Huh?
Find a good rate.
Find a what?
Good rate. Like
Okay.
doing like a loan.
Good rate on what?
Almost your loan. If you're
On a loan?
Yeah.
Oh, okay. So you would tell them to go borrow some money?
If you need it.
Well, that was the assumption, that you needed some money. The assumption was that you needed some money and you had a financing section. You wanted to get some money. So what's your name again, sir?
Armin.
Huh?
Armin.
Armin. So you're saying, Armin, you would tell them to borrow some money?
Yeah.
Well, I mean, it's your example. What are you,
Yeah,
you're shrugging at me for?
I
Huh?
was assuming that you need to borrow money when you said finance.
Okay, let me start over again. I have a need to get capital into my business. I have a financing department, and I'm asking them to get some money. I mean, they could go to the bank and rob the bank, but that probably wouldn't be advisable. So you're saying that they should go to the bank and borrow some money?
See if we have money first.
Okay, let's move on to maybe somebody else wants to contribute. How would you get this company to get some money in for the project that you are trying to finance? Huh? Oh, okay. That's a way to get money in. You would sit there and say, hey, go issue some stock, right? Sell some of our stock. Okay, so let's say they take you up on that and they say, okay, that's what we're going to do. And they go ahead and they sell stock for $1 million. So they debit cash $1 million. What should I credit when I issue stock? Huh? What account? Common stock, good. So I go ahead and I credit the common stock $1 million. Is that the journal entry you make? Now, let's say this is the only transaction that happens. My financiers go out, we start this corporation, they issue stock for $1 million. Can I prepare an income statement? Can I prepare an income statement? The answer to the question of can I prepare any financial statement is always yes. I can prepare the financial statement. Okay, so when I prepare my income statement, why do you call it the income statement? Because it shows net income. So, how do you calculate net income? Revenue minus expenses. Do I have any revenue? This was the only transaction that happened. Do I have any revenue? This is the only transaction that happened. Do I have any revenue? Okay, so revenue is 0. Do I have any expenses? This was the only transaction that happened. Do I have any expenses? So my expenses are 0. So what's my net income? 0. Good. Can I prepare a statement of retained earnings now? Answer is always yes. Beginning balance is 0. What do I add? What do I add? Net income is 0. What do I subtract? Dividends. Did I pay any dividend? Nope. That's 0. So what's the ending balance? 0? Yeah? Okay. So now I can go ahead and prepare my balance sheet. Why do they call it a balance sheet? Because it balances. What balances? Assets equal liabilities plus stockholders' equity. Very good. Okay. Any assets? I'm not going to tee these up, guys. Any assets? Cash. Okay, good. I have cash of $1 million. Any liabilities? Liabilities are 0. Any stockholders' equity? Common stock, which I'm going to abbreviate CS, is $1 million. Does the balance sheet balance? Okay. All right, good. Now I can go ahead and prepare a statement of cash flows. Okay. Now my statement of cash flows, I'm going to have an operating section. I'm going to have a investing section. And I'm going to have a financing section. Now, in the financing section, I show financing, which is what? Where I show if I issued stock to get some financing, if I borrowed some money to get some financing, that's where I'm going to show that kind of activity. So I ask you, did I have any transactions where I had issued stock? Yeah, I issued the common stock, didn't I? Okay. So I will report in the financing section, operating is 0, investing is 0. The only thing that happened was a financing activity, and I will report cash provided by common stock issuance. Now, guys, we can take some creative license as to how we describe what it was. Okay, so I'm just writing some maybe more detail that you might see, just so you understand what's happening here. But stock provided by common stock issuance, cash provided by common stock issuance, how much cash came in? $1 million. Okay. Then I will report the beginning balance of cash. What was cash beginning balance? Beginning balance was 0 when I started the company. And I will then what? Add the cash provided by common stock. So what's the ending balance? $1 million. So when you pick up this statement of cash flows that I just prepared, I guess I should have put statement of cash flows as a heading. When I prepare that statement of cash flows, SCF, statement of cash flows, when I prepare that, now investor can pick that statement up and say, I see what happened. You what? Started the year with no money, and you got $1 million in here through financing activity. You know that by looking at the statement of cash flow. And I know you could have said, well, John, I don't really need that if all you have is $1 million of cash and $1 million of common stock. Obviously, that's how you did it. Did we really need the statement of cash flows? Well, not for just tracking one transaction through the process, but if I have several transactions, then this might be very helpful to me, right? To see how cash was provided by financing activity. Question? Yes, sir. Huh? No, you're good. Oh, just stretching? Just fighting to stay awake? Okay. Question? Okay, good. So we have our first year, and we prepared our, our little statement of cash flows here. We got our little balance sheet. And so let's say in year 2, and I'm going to try to change colors up. I should have got better colors. They're a little pastelish, so bear with me if they're a little hard to read on the monitor for folks watching, but I didn't bring any darker colors. I guess I could do red maybe. Let me try red. This is a little too pastel. But let's say now, in my second year, I go ahead and I buy some equipment. And I spend $800,000 on equipment. Okay? Well, when we get to an activity like that, now we're sitting here and we are dealing with our investing activity. So what happens? You have your department, your financing department, they borrow money, they issue stock, and you say, okay, great, you got some investing in here. Now financing in here. And now you turn to your investing person and say, invest this money. How are they going to invest it? What kind of things would they do to invest money? When you think of somebody investing money, what are they doing? Okay, buying assets like what? Like property, plant, and equipment? Okay, so you say, hey, go invest in some equipment, and when we get that equipment in here, then we're going to start this business rocking and rolling, right? Okay, good. Or maybe you say, hey, go invest in the stock of some other company, right? Is that what you do when you make an investment? You could do that. I mean, you may not do that in the early stages of a company that's, trying to generate money through, various operations. But if you were going to invest some excess money into some stock, you might do that, right? Okay? So, when we're dealing with the investing section now, we are dealing with when a company takes some capital that they have and invested in what? Property, plant, and equipment, or possibly invested in some sort of investment like stocks, bonds of other companies, that sort of thing, right? Okay. So let's say I go ahead and I take of this $1 million, I take $800,000 and I buy some equipment. If I spend $800,000 of cash, which should I credit? If I spend $800,000 of cash, which should I credit? Cash, good. What should I debit if I buy equipment? Equipment, good. I'll abbreviate that EQ. 800,000. That's a debit. Okay, so I go ahead and I do that. Can I prepare an income statement? And guys, I'm just gonna, save me some writing and some stretching, and my income statement's going to look just like it did in year 1. I don't have any revenue, I don't have any expenses, net income is 0. My statement of retained earnings is going to look just like it did in year 1. Beginning balance is 0, no net income, no dividends, ending balance is 0. Right? Now I prepare my balance sheet. Okay, and when I prepare my balance sheet for year 2, year 2 balance sheet, do I have any assets? What do I have for assets? I have cash of what? 200,000, don't I? I have equipment of how much? 800,000. My liabilities are still 0, and my stockholders' equity is still common stock of $1 million, isn't it? Does my balance sheet balance? Okay. Now I can prepare a year 2 statement of cash flows. So when I go for this year 2 statement of cash flows, okay, statement of cash flows for year 2, and my operating is 0. My financing, I'll just kind of write the financing down here, I guess. Financing is 0. I didn't issue any stock. I didn't borrow any money. All I did was I took some money I already had, and I did what? I bought some equipment, didn't I? So I'll write here cash for my investing. I invested in cash. I invested in equipment. So in my investing section, I'll write cash used to purchase equipment, $1 million. I show that as a subtract. My beginning balance of cash was how much? Oops, I didn't use $1 million, I used 800,000. Cash used to purchase equipment was 800,000. My beginning balance of cash was how much? What was the beginning balance of cash on my balance sheet? It was what? $1 million. Now it's year one, end of year one is the same as the beginning of year two. It was $1 million at the end of year one. Now at the end of year two, it's what? 200,000. So the beginning balance of cash was $1 million. What's the ending balance of cash? Ending balance is what? 200,000. So you can look at this statement of cash flows and you can say, I get it. You used $800,000 of cash investing in your company by buying equipment. Does the statement of cash flows tell me that? Now, I didn't need the statement of cash flows to track this one transaction through, but if there were several transactions coming and going, this would be very useful for me as I'm saying, oh, I see a company that in year one, they got more financing coming in. Now in year two, they're getting things off the ground, making some investments. Yeah, it's not great that they had less cash than they had at the beginning of the year, but I kind of see the progress that's going on here. And of course, we have 52 footnote disclosures that are talking about what's going on as well, right? Remember, any set of financial statements will have a set of footnotes that'll make it more understandable to the users, right? Question? The balance sheet what?
The balance sheet shows the same thing. This shows like certain operations, like operating, financing, and investing. Can we just
What?
Can we just show it on the balance sheet and not the cash flow? Like,
How?
what's the difference on the?
How would I show it on the balance sheet?
Can we show it on like assets and cash, how it increases and decreases?
So you're suggesting that if I were to pick up Apple's balance sheet, you would be able to tell me how much money they spent on investing, financing, and we haven't gotten to operating yet? You could pick up Apple. I'll put Apple's balance sheet up there, and you tell me how much cash they spent on investing activity and financing activity. Are you prepared to do that? Are you prepared to pick up Apple's balance sheet and tell me how much money they spent on investing and financing? Huh?
No.
So how would I show it on that? What do you want to do? What kind of new balance sheet do you want to engineer that allows us to do that? Okay. I understand what you're saying. Look, man, I can see it right here. The cash went down from $1 million to 200,000 and equipment went up. Bleh. No kidding. They spent on buying equipment, right? Because you can see it right there. If you just have one transaction going through and you're following that, and I'm glad you're kind of seeing that bouncing, what they call it, bouncing ball, as it goes through. But if you have several transactions affecting the company, you couldn't come up with that that's my point about Apple. Question? Okay, good. Now, let's do a quick little test where we will sit here and see if we can figure out how to categorize some of these things up here. Question? I see a question? Okay. All right, good. So let's take a look. Issued common stock. Investing, financing, or operating. Don't worry that you don't know what operating is right now. Investing, financing, or operating? financing, good. Borrowed $200,000 from the bank, investing, financing, or operating? Financing, very good. Purchased a semi-trailer truck. Beautiful. Question. Okay, good. So we understand operating, we understand investing. Guys, it's really not much more. Well, there are some couple things that are a little more complicated than that, but we'll get to those. Okay. Should I do this now? Yeah. Why not? Let's do one more investing thing.
Is there any intuition or reasoning for the third one to be investing, given that the moment the truck leaves the dealership, it loses like half of the value? Like, it's a pretty bad investment on paper. Why should it not be, like, given this, why is it not classified as operating, given that this is the only reasonable justification?
I'm trying to unpack that question. Because first you said, as soon as the truck leaves the dealer, it loses value?
Yeah.
And you want me to make an adjustment for the loss in value of this equipment?
I'm just saying that there is no reasonable justification that the firm sees this as an investment that it can later sell on for profit. Like the
Well, I would
justification-
say that the owners of this company need to reassess their process if they buy equipment for which they perceive no future economic benefit. I'd really wonder what they're doing. If they're buying equipment and they don't perceive any future economic benefit, I would not only say that I will not invest a dime in that company, I think that, certain authorities should start to take a look at them, because it's questionable why they're taking cash from investors and spending that money, their investors, and spending money on things that they think won't have any future economic benefit. The ball's on your side of the net.
So I guess this would the depreciation be considered like?
We're not there yet. Don't start me on depreciation. We're not there yet. Anything else? Okay, so we go ahead and we do what? We have this financing activity, and let's say this investing activity. Let's say the company, Ivan, decides, I don't want this truck. I'm going to get rid of it. I'm going to sell the truck. I'm going to sell the truck for, thank God I found some responsible citizen that's willing to pay me $800,000 for it. Okay? So they pay them $800,000 for it. When somebody buys a truck from me for cash, what do I debit? Huh? Hang on a minute now. We'll get to this in a second. When somebody buys a piece of equipment from me for cash, what do I debit? What do I debit when somebody buys something for cash? Huh? Cash, good, okay. And if I sold them the equipment, what should I credit? Huh? Equipment, good. Now, when I prepare the income statement, guys, revenue is zero, expenses is zero, net income is zero. What else? Beginning and balances, retained earnings is zero, no net income, no dividends, No. So the ending balance is 0. So when I prepare my balance sheet, how much cash do I have? If I started out with 200,000, how much cash do I have? Million. Good. Liabilities are still 0. Stockholders' equity is still $1 million. So the balance sheet balances. What do we do to a common stock is $1 million? What do we do to a balance sheet that doesn't balance? We beat it until it does. Okay. Now I can prepare my statement of cash flows. Operating is 0. Investing, financing is 0. Investing, did I have any investing activity? I sold an asset that I was using in the business and I got $1 million cash for it, didn't I? So, cash goes out, cash comes in, doesn't it? From investing, and I sold a piece of equipment that I was using. How much did I sell it for? Sale of equipment, $1 million. Financing was 0. Operating was 0. Beginning balance, how much did I say they sold for? 800,000. Beginning balance of cash was what? 200,000. Ending balance is what? $1 million. So you sit here now and you say, oh, I see. The proceeds of the sale of that asset came in the investing, didn't it? And now you have $1 million of cash. You exchange cash for equipment. And I know, Sandro, you're like, well, why do I need a whole nother statement to tell me that? You don't need it if it's just one transaction. If there are several transactions, you need this, right? Money came in, money went out. If you're sitting there and doubting any of this, it's because you don't understand enough about accounting. Go ahead.
So for a standard, I understand the example. I'm just a bit puzzled by the classification.
Well, you're puzzled by the classification because you don't understand enough about accounting.
For a standard,
which is surprising, but go ahead.
For an average company.
For what?
For an average company, would you say that investing activities tend to be losing cash? Because in this example, you buy equipment for $300,000 and you sell it for $800,000. In reality,
I bought it for $800,000 and I sold it for $800,000. I didn't buy it for $200,000. I bought it for $800,000 and I sold it for $800,000.
okay. But in reality,
What reality? This is reality. What do you mean reality? Are we in a fantasy world? This is not the Matrix, is it? This is reality. Okay, good. Now, what happens? Now you can go ahead and do what you're going to do. Okay. Go ahead and do what you're going to do now. Okay, good. Now, we understand the investing section. Let's review now that we're past that distraction. Investing activity, when you invest in what? Property, plant, and equipment, cash goes out. You use cash in investing activity. And if you were to sell that equipment, then what? Cash would come in, wouldn't it? Okay? Okay, good. Now we can get to the operating section. So let me get back. Okay, operating section. An operating section of the statement of cash flows is going to show those day-to-day activities. Okay? Day-to-day activities are things like what? Making sales, having expenses, right? These are day-to-day type activity. Okay? So, we go ahead and I'm going to erase this part here. Pretend this part didn't happen. we still have the equipment that we bought for $1 million. That we bought for 800. So we're here. We're right here, right? Forget that little riff off of selling the equipment for now. We still have the equipment. We still have cash at 200,000. Okay. And now I go and I provide a service and I tell my customer, pay me later. You can pay me later. It's okay. If I provide the service, can I take the revenue? I can. So I go ahead and I debit. I credit. What do I credit when I provide the service? What do I credit when I provide the service? What? Don't make me come back there. What do I do when I provide the service? Credit revenue. Say I'm just going to make up a number here, guys, 100,000. Can I debit cash? If I told the customer, pay me next year, I can't debit cash, so what do you want me to debit? Accounts receivable, good, for 100,000. Good. This is the only transaction that happened the whole year. This is it. No expenses, no nothing. Okay? So, can I prepare an income statement? Can I prepare an income statement? Okay. Let's see. Where's my little income statement template? For year 3 now, do I have any revenue? Do I have any revenue? How much? It's right there. 100,000. Good. Do I have any expenses? Do I have any expenses? So if my revenue is 100,000 and my expenses are 0, how much is my net income? 100,000. Good, 100,000. Right? Okay, good. Now, my statement of retained earnings, beginning balance is 0. What do I add? 100,000 in net income, good. Dividends are 0. Ending balance is 100,000 in the retained earnings. Good. Can I prepare my balance sheet now? Where'd my balance sheets go? Right here. Can I prepare my balance sheet now? Year 3 balance sheet. Okay. Assets. Do I have any assets? I have what? I have accounts receivable of 100,000, don't I? Well, let's start with the cash. If my ending balance in cash was what? What from year 2 was 200,000, and all I did was debit accounts receivable and credit revenue. What's my beginning balance of cash year? My ending balance of cash year 3. How much? Good. Cash is 200,000. My accounts receivable is what? 100,000? Is that an asset? Accounts receivable is 100,000. Any other assets? I have what? Equipment? 800,000. The equipment is still 800,000. So how much do I have in assets now? Total assets is 1,100,000, I believe. Liabilities are still what? 0. My stockholders' equity is common stock is still $1 million. And now my retained earnings actually has a balance. My ending retained earnings is not 0 anymore. It's 100,000, right? Right? Does the balance sheet balance?
Yes.
Yes, it does, right? Okay, good. Now I can prepare my year 3 statement of cash flows. Remember, I'm ignoring that sale. We didn't just pretend we didn't do that, right? So my statement of cash flows, the sale of the asset that I was doing to entertain the question. And now in my operating section, and with your operating section, you start with net income. And my net income here was 100,000. Right? Then you analyze your current assets. What are current assets? Those that will be liquidated into cash in a year or less. For example, remember we said accounts receivable is pretty much always a current asset. So you analyze your current assets. In my current asset, accounts receivable went from what? It went from 0, didn't even exist. It went from 0 at the end of year 2 to what? To 100,000 at the end of year 3? 0 at the end of year 2, 100,000 at the end of year 3. So what I do is I subtract increase in the current asset accounts receivable my cash provided by ops is, if my net income was 100 and I subtract 100,000 for the increase in accounts receivable, what's the cash provided by operations? If you have a net income of 100,000 and you subtract 100,000, the increase in accounts receivable from it, what's the cash provided by operations? What? If I have 100,000 of net income and I subtract 100,000 from 100,000, what's the cash provided by operations? 0. Investing activity was 0. I didn't buy any equipment. I didn't sell any equipment. Didn't issue any stock. Investing is 0. Financing is what? I shouldn't have said I didn't sell any stock. I didn't buy any stocks. I didn't make any investment. I didn't issue any stock. I didn't borrow any money. Investing is 0, right? Okay. So what's the ending balance? I mean, what's the, not the ending balance, what's the change in cash? Change in cash is 0. 0 plus 0 plus 0 equals 0. Beginning balance of cash was what? Beginning balance of cash, year 2's ending balance is year 3's beginning balance. Beginning balance was 200,000. Ending balance is how much? 200,000. 0 plus 0 plus 0. Change in cash is 0. Beginning balance is 0. 0 plus 200,000 is 200,000. Ending balance is 200,000. Is that correct? Is that the ending balance? So someone looks at my statement of cash flows and they say, well, I see on your income statement you reported net income of 200,000. Okay, that's nice. But did you get any cash? And the answer is no. I did not generate any cash from that operation. Even though I showed you net income, no cash was provided. So now I go to year, what are we on, 4 now? And the only thing that happens is I collect some cash from that customer. That's all that happens. I get some cash from them. Let's say I get 70,000. When you receive cash from a customer, what do you debit? Cash. If it was paying you for an account receivable, what should I credit? I credit the account receivable. Okay. Can I prepare the income statement? How much revenue do I have? All I did in year 4 now was collect that cash, right? From that customer that I did the service for last year. So how much revenue do I have? Revenue is 0. Expenses are 0. Net income is 0. Beginning balance and retained earnings was what? 100,000 now? Net income, was that what it was? Yeah. And net income is what? 0. Dividends are 0, so the ending balance is 100,000. Okay, statement of retained earnings. I prepare the year 4 balance sheet now. And when I look at the year 4 balance sheet, do I have any assets? My cash is what? Cash is still 200,000, isn't it? Oh no, what's my cash now? I started with cash at 200. I just debited it for 70, didn't I? So my cash went from 200 to what? 270,000. My accounts receivable was what? 100,000. If I got 70 of it, what's the account receivable now? 30,000. The equipment is still what? 800,000. My total assets now is what? 1,100,000. My liabilities are what? 0. My common stock is 1,000,000. My retained earnings, ending balance is what? 100,000. Does the balance sheet still balance? Does the balance sheet still balance? Does the balance sheet still balance? Okay. Okay, good. So now I can prepare my statement of cash flows for year 3 here, or year 4, excuse me. I'm going to write it in black because I'm not digging this blue. Okay, so what's my net income? Operating section, you start with net income. What's my net income? What was net income here? Net income was 0. Start with net income of 0. And then I add the decrease in accounts receivable. How much did my accounts receivable decrease? It was what? Good. It was, just looking up here on my balance sheet, it was what? It was 100, now it's 30. So my accounts receivable decreased 70,000. So I add the decrease in accounts receivable. Cash provided by ops, therefore, is what? 70,000. Investing is 0. Financing is 0. Beginning balance of cash was what? 200,000. I have cash provided by operations of 70, so the ending balance in cash is what? 270,000. Is that the ending balance of the cash? So now you look and you're like, okay, I see that you didn't have any net income, but you did start to generate some cash. Although it was something that happened last year, this year you're starting to generate some cash from your day-to-day activity like having revenue, right? Statement of cash flows is showing you that. Okay, good. Now, I go into, guys, we can go ahead and please put up the screen and turn the lights on the other side. Did I lose the control room? There we go. Do 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 do. Okay. Now, in year 5, wherever we are now, the only thing that happens is I incur an expense on credit. When you incur an expense on credit, are you going to use any cash right now? No. Okay. So I incur that expense, and so I go ahead and I debit expense, whatever it is, for we'll make it oh yeah, we're okay. $50,000. And I credit, if I'm doing it on credit, can I credit cash? What do I have to credit? A liability, say account payable. $50,000. Okay. When I prepare my income statement, now on whatever year on this income statement template I'm using, my expenses are, my revenue is 0. My expenses are how much? 50,000. So I have a loss of 50,000, don't I? Okay. All right, good. So I have a loss of 50,000. My beginning balance of my retained earnings was, I shouldn't have used 50,000 because it's 50,000. That's all right. My loss is what? 50,000, so I subtract the loss. No dividends, so the ending balance of retained earnings is how much? 50,000. Okay. I go ahead and I prepare the next year's balance sheet. My cash, guys, I'm just going to do this so that I don't have to write the word cash again. My cash is how much? 270,000. My accounts receivable is still what? 30,000. My equipment is still 800,000. Do I have any liabilities now? I have what? Now I do have a liability. I have account payable of what? 50,000. My common stock is still $1 million, and now my retained earnings is 50,000. Retained earnings of 50,000. Does the balance sheet still balance? Does the balance sheet balance? Does the balance sheet balance? Now I can prepare my statement of cash flows. When I prepare my statement of cash flows, the net income is how much? What's my net income? What's my net income? What's my net income? What? Negative 50,000. It's a loss. fact, I can just call it a loss. And now I look and I analyze my current assets and my current liabilities, my current items, current assets, current liabilities. My current assets stayed the same, didn't they? But my current liability did what? Went up, didn't it? Okay. So now I add the increase in account payable of 50,000. So now my cash provided by ops is what? Cash provided by ops is 0. Net income was 0. Added the decrease in the account, the increase in account payable, excuse me. The cash provided by ops is 0. Investing is 0. Financing is 0. Beginning balance of cash was what? 270. Ending balance in cash then is 270. And now someone picks up my statement of cash flows. They don't look at their phone while they're trying to follow a statement of cash flows. Now someone picks up my statement of cash flows and they say, well, I see you had a net loss of 50, but you didn't use any cash from your operation, right? Statement of cash flows tells me that. Now what? The next year, I go ahead, and the only transaction I have is I pay some of that bill. How much do I owe them? 50? Let's pay them 30. So I go ahead. When you pay a bill, do you decrease your liability? How do you decrease a liability? I debit account payable. How much did I say I paid them? 30? I credit the cash, 30. I go ahead and I prepare my income statement first. If that was the only transaction that happened, do I have any revenues? If that was the only transaction that happened, do I have any revenues? Revenue is 0. Do I have any expenses? Expenses are 0. My net income is 0. My beginning balance in my retained earnings is last year's beginning balance. Last year's ending balance. So my beginning balance was what? Last year's ending balance is this year's beginning balance. What was my ending balance last year? 50. That's this year's beginning balance. So I go ahead and I put the 50. Net income is 0. Dividends were 0. Ending balance is 50. I prepare my balance sheet for the next year now. Assets. Cash is how much now? Well, I did spend 30,000 cash. If it was 270 now, it's what? 240? So my cash is 240. My accounts receivable is sitting there at what? 30,000 still? Okay. My equipment is still sitting there at 800,000. My any other assets? No? What's the total of my assets? What's the total assets? I'll wait. How much? 1,070,000, you say? Like that? Okay, good. Do I have any liabilities? My accounts payable was 50. If I paid 30 on it now, it's what? 20. My common stock is still sitting here at what? 1 million. And my retained earnings is still sitting here at 50,000. Balance sheet still balances. Now, when I prepare my statement of cash flows for that next year, income statement. Statement of cash flows. Net income is how much? How much is my net income? 0. And now I subtract the decrease in account payable. How much did my account payable go down? It went from what? From 30 down to 20? From 50, down to 20, so it decreased 30. So I subtract the decrease of 30,000. Investing has been 0 for some time now. Financing has been 0 for some time now. My beginning balance of cash was how much? Beginning balance of cash was last year's was 270. The ending balance of cash was what? 240. I had a decrease. I didn't write you'd write a line decrease 30, but the ending balance is 240. I subtracted the 30 for operations. Ending balance is 240. So now you look at that statement of cash flow and you say, well, yeah, you didn't show a loss, but geez, you did use some cash, didn't you? From your operations, even though it was something that happened last year. Okay, so big note time. Investing, financing, you issue stock, you borrow money, that's down in financing. Investing, you take some money and you make an investment, say in private plant equipment, that's investing, right? Operating, first thing you do, right over here, start with net income. Always. So this over here is the rule for the operating section. This is how you do the operating section, guys. And if you're sitting there saying, oh, well, now he's going to show us how to memorize something. I have students, former students, that go to work for a CPA firm, and their supervisor turns to them and says, prepare the statement of cash flows. The supervisor wants to see the balance sheet is there. The income statement is there. Can you look at the balance sheet and income statement, and can you prepare a statement of cash flows? And I'll get a call at 10 o'clock at night. Hello, is this Professor? Are you still an accountant? Yeah. Remember when we talked about the statement of cash flows and you told us to write something down? What was it again? Always start with net income. Analyze current items. Analyze current items. Analyze current items. For current assets, do the opposite. For current assets, do the opposite. Let's go back. Let's see what happened. We analyzed the account receivable, and when the account receivable went up, what did we do on the statement of cash flows? When the account receivable went up, we subtracted the increase from net income, didn't we? When what happened? When the current asset account receivable came down, we did what? On the statement of cash flows, we added the decrease, didn't we? We added that decrease, 70,000, it went down 70,000. We added that, didn't we? When it went up, we subtracted it. So we did the opposite, didn't we? For current liabilities, do the same. Well, let's look back and see what happened with the current liability account payable. When the what? When the account payable went from what? Went from 0 to 50. And went from 0 to 50, and we got to our statement of cash flows. Didn't we add the increase? We added the increase, didn't we? And when the what? When the account payable went from 50 to 20, it decreased 30. What did we do? We subtracted the decrease. We did the same. It works the same for every single current asset, for every single current liability. I'm not going to go through 5,000 different current assets and current liabilities. We did it for account receivable. We did it for account payable. It works the same for every single current asset, current liability. And I'm not going to prove that to you. It works the same for every single one of them. Now, if I have depreciation, what journal entry should I make? Let's say I have, let's make it 80,000 of depreciation. Let's go ahead and depreciate that a piece of equipment, okay? Although I'm just going to show it to you for just to pretend I have equipment, and I'm going to depreciate it, and I'm going to depreciate it. How much? 80,000, I said. Yeah. What journal entry should I make when I depreciate the asset? What journal entry should I make when I depreciate an asset? Don't make me do chapter 8 again. What journal entry do I make when I depreciate an asset? Huh? What? Okay, I'm going to debit depreciation expense. What did I say? 80,000? And I'm going to credit, and you don't credit directly to the asset, not account payable. You credit accumulated depreciation, guys. I mean, don't tell me that you're getting into the weekend and you're not studying accounting over the weekend. I mean, we just talked about this last week. How could you forget it already? Because I know you sat there and did nothing but look at accounting all weekend. You debit depreciation expense. You credit the accumulated depreciation, don't you? Is that what you're supposed to do? Did any cash get used? So if I prepare my income statement, that's the only expense that happened. If I prepare my income statement, I have revenue of 0, only transaction that happened. Expense is what? 80,000. So I have a net loss of 80,000. When I prepare the statement of cash flows now, forget everything else that we've talked about with this. Just pretend this is a new company, different company now, right? I start with what? Always start with net income, net loss. I start with a net loss of how much? 80,000. And I always add depreciation. I add depreciation because depreciation reduces net income, but it doesn't use cash, does it? So my cash provided by ops is 0. And indeed, It is zero because no cash came in. I just had a piece of equipment that I depreciated. I had an expense of $80,000. I had a net loss of $80,000, but it didn't use any cash, did it? So you always add depreciation. Always add depreciation. By the way, I'm talking about what? What to do to net income here. Start with net income. For assets, do the opposite. For current assets, do the opposite. For current liabilities, do the same. Always add depreciation. We're talking about adjustments to net income, right, to get cash provided by operations. Always add depreciation. Now, that piece of equipment. Remember we sold it for $800,000? Remember we sold it for $800,000? Let's say we sell it for $700,000. We sell it for $700,000. I'm using equipment. This could have been land. Whatever. I sell an investment that has a carrying value of $800,000 and I sell it for $700,000. Is that a gain or a loss? That's a loss, isn't it? Okay, so pretend this is the only transaction that happened. I had a piece of equipment that had a book value of 8 and I sell it for 7. What journal entry should I make? I sell a piece of equipment for $700,000 cash. What journal entry should I make? Huh? Debit cash for how much? $700,000. What should I credit? Equipment. I'm getting rid of the equipment or land or whatever. Okay, whatever I'm depreciating here. I mean, whatever I'm selling. Equipment for $800,000. Do I need a debit or a credit to make this journal entry balance? I need a debit to make the journal entry balance. What should I debit? Huh? What? No. What? It's a piece of land. Let's say. Huh? It's a piece of land, let's say. Do you appreciate land? Okay. Loss. We don't call it expense. Expense is the word that we say for day-to-day operations, and selling your equipment is not a day-to-day operation. Did Nordstrom's try to sell you a cash register last time you went in there? They did? No. They don't sell you cash registers. They sell you clothes, don't they? But they may sell their cash registers, and if they sell them at less than the carrying amount, that is called a loss. I'm going to put the income statement right here. Do we have any revenues? Do we have any expenses? No. But we do have a loss on sale of equipment, don't we? Of $100,000. So my net loss is how much? $100,000. When I prepare the statement of cash flows, I think I can fit it here. Statement of cash flows. Always start with what? In this case, net loss, $100,000. And I add the loss. So cash provided by ops is 0, isn't it? Is 0? But I proceed to the investing section. And I take the proceeds to the investing section. What are the proceeds of this transaction? The proceeds are what? The $700,000 cash that came in? Didn't cash come in? $700,000? And that's reported just like when I gave the example earlier when we were selling stuff over there a minute ago. In the investing, I have cash from sale of equipment. How much cash came in? Oops, 700,000. Good. Beginning balance of cash, I'm going to assume was 0 in this little transaction, was separate from everything else we were doing. And the ending balance is 700,000. And you see that what? The what? Cash came in from the sale of this equipment. So now our rule is what? For losses and gains, do the opposite. If I have what? If I have a loss, I add it. If it was a gain, I would do what? I would subtract it and then do what? Proceed to investing. Put the proceeds where? In the investing section? Where they belong? Now, if it was a gain, I would do what? I'd subtract the gain, because that's not the cash effect, the gain that we report. Okay? So do the opposite for gains and losses. Now, let me ask you a quick question. Let's say you were going to invest in a not-for-profit type activity, and they said, all profits will go to the charity. What was the profit in this situation? What was the profit in this situation where we just sold this equipment? Whatever we sold here. What was the profit? What was the profit? It was a loss. I mean, apparently the charity owes this company money now. If they say to you, the proceeds go to charity, that's 700,000 that's going to the charity, isn't it? So do you want to invest in a charity that says, all income, you see somebody's hand up, all income will go to the charity. Meanwhile, they're buying themselves, the fanciest threads in town when they stand up there and say, please send us your money. That's an expense. Please send us your money. That's an expense. I only have to send the profits. Ain't going to be no profit by the time I get done with this thing. If they say proceeds, any money that comes in got to go, right? So the proceeds is the amount you get in, isn't it? Proceed to the investing section. Okay? Okay, now. So we analyze current items. For current assets, say it. For current assets, say it. Do the opposite. For current liabilities, do the same. If it's an asset, if it increases, subtract it. If it decreases, add it. If it's a liability, if it decreases, subtract it. If it increases, add it. Okay? Then what? Losses and gains, do the opposite. And always add depreciation. In other words, for the operating section, you should clad, with 2 A's, I guess, you should clad yourself as a genius. Clad yourself as a genius. If you remember to analyze current items for assets, do the opposite. For liabilities, do the same. If you remember for losses and gains, what? L stands for losses. For losses and gains, do what? Do the opposite. And always add depreciation and amortization, guys. Depreciation, amortization, just different words for the same effect. If you do that, you can't mess up a statement of cash flows operating section. And the investing and financing are easy. We've already passed the test on that, haven't we? That little quiz I gave you. Okay, guys, we can put the screen back down. Question? We can put the screen back down. Thank you. Takes a second. Do 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 do. Now you know why I became an accountant. Okay. Now, let's look. We did this financing. Paying employees is operating. Collecting cash for services is operating. We know that now. Okay? There will be a difference, as we have seen, between net income and cash provided by operations, right? I mean, there's very, very few, unless they were an all-cash company, that you're going to have, what, the same number for net income and cash provided by operations? We saw that. Okay? Okay, now what I showed you is the direct method. I'm not going to show you the indirect method because 95% of the companies, or whatever it is, 98, almost all the companies use the indirect method. And I'll explain that a little bit more here in a second. Okay, because what I want to do is proceed to this example where we have a company, they have an income statement, they have a balance sheet, and we should be able to prepare, they give us some information about depreciation and so forth, and they should be able to prepare statement of cash flows from these two things, shouldn't they? When you become a CPA, this is what they're going to ask you to do. Not yet a CPA. You're going to be your first year working for a CPA firm. And you're going to think, they would never trust me to prepare the statement of cash flow. And then all of a sudden, they're going to turn to you and who was a previously nice supervisor, their head's going to become the head of a dragon, and they're going to go, and you're going to go, oh, shit. Really? But I'm just a child. I can't prepare the statement of cash flows. I'm just a baby. Ah. Here's what you do. You'll start with net income, and for assets, you will do the opposite. For liabilities, you will do the same, won't you? So and you will always add depreciation. For losses and gains, you'll do the opposite. You're going to clad yourself in genius. So we start to look at the information here, and what happened? Oh, there it is. Depreciate. Where's my income statement? I'm trying to get to the income statement. Depreciation expense, $9,000. What am I supposed to do with that on the statement of cash flows? Add it. Let's see. Please, God, make sure they added it. Add. They had a loss on disposable equipment. What are you supposed to do? The opposite. They added the loss. Did they add the loss? After you add the loss, where are you supposed to proceed? Where do you proceed? To the investing section. And when we look at the investing section, they've got money that came in for the sale of equipment, $4,000. Is that where you report it? So they sold it for $4,000? Even though it ended up generating a loss on the income statement, they show the proceeds in the investing section, don't they? Okay. What else? Current items for assets do the same. For liabilities, for assets do the opposite. For liabilities do the same. Okay. Let's take a look. Let's see. Okay. Accounts receivable decrease. Should I add it or subtract it? Accounts receivable decrease. Should I add it or subtract it? Add it. You do the opposite, don't you? Is that what they did? Oh, yeah. Decrease in account receivable, they added it. Same thing for...
What if the customer defaults on paying the product? For example, the Apple and then the accounts receivable, the customer...
Well, the customer doesn't pay me on the account receivable. Will the account receivable decrease? If the customer doesn't pay me, will the account receivable decrease?
It stays the same.
Huh? It stays the same. If they never pay me, then there'll never be any impact on cash provided by operations from collections on account receivable, I guess. However, if there is bad debt expense, which happens at the time that I make the sale, then I would report bad debt expense, wouldn't I? And when I report the bad debt expense, my income will come down, won't it? But no cash goes out? What do I want to write this? When I have a sale, I debit accounts receivable, say for $100,000, and I credit the sales for $100,000, right? At the same time, if I have determined that 1% of this will go bad, I will debit bad debt expense. What's 1% of 100,000? 1,000. I'll credit the allowance for 1,000. Did any cash go out as a result of that expense? Did any cash go out as a result of that expense? So I would add the increase in an account like bad debt expense, right, to the net income to get cash provided by operations. Although, because accounts receivable increased $100,000, I'm going to subtract that increase from my net income, assuming nothing else happened. My net income was $100,000. That's how that would appear on the statement of cash flows. So that my net income would go, if this was the only transaction that happened, I'd have what? A net loss of $1,000. I'd add back the bad debt expense. That would put my cash provided by operation at 0, which it is. Well, I guess my net income, would be $99,000 something, whatever. So, bottom line, bad debt expense is what? Is an add back, isn't it? Because it's just like depreciation. Didn't use any cash. Okay. Where am I? So what happened? Let's see. Accounts receivable decreased. Inventory and prepaid expenses increased. Is inventory a current asset? Are prepaid expenses a current asset? Did they decrease? Did they increase? So what should I do? Subtract them? It works! Increase in account payable. What do I do with an increase in account payable? I do the same. I add it. Did it increase? Account payable. Where's my liabilities? Account payable. It increased. So I did what? So I added it. Is the rule working? Payment of dividends. Oops. Payment of dividends, guys, is considered a financing activity. If issuing the stock is financing, and then I end up paying a dividend to somebody as financing, it's still financing, isn't it? I mean, when you pay a dividend, that's kind of like the, if you will, the interest that you pay your shareholders. Do you like this company? This little company that's on the board right now? Do you like them? What do you think of them? Huh? They paid you a dividend. That's all you look at? Do you like that company that we had in one of the examples where they had a net loss and they paid a dividend? Did you like that company? I'm looking at that company saying, well, somebody's driving drunk and I ain't going to be in the back seat when they go over the cliff. Sell. This company did what? They made some income and they generated some nice healthy cash from operations, didn't they? In fact, they had more cash from operations in their net income. I'm kind of digging that. And then I'm looking and saying, okay, and they took some of that cash from operations and they invested it in some equipment and a building. Geez, you know, what a bunch of bums. They went and bought equipment What bums? They bought equipment to generate $145,000 in net income and $170-something in cash provided by operation. That's fucking pretty good. That works for me. I'd be sitting there telling them, here, take my watch, do some more. And they even found the opportunity to pay me out a little dividend now, didn't they? And they issued a little common stock because maybe, they wanted to finance some of that purchases, not from retained earnings, not from income that's been generated, but they got a little more capital in, right? Not a bad little company. Statement of cash flows revealed a heck of a lot more than just showing me net income is this and not really showing me what happened with the cash, right? This thing does that. Question. Now I know we went through a long, and you're probably like, the long and winding road. Why did we have to go through all that? Because if I would have started with this, you'd have gone, what the hell? Why are you adding depreciation? Now, quickly, I think I'm going to have to do this real quick. Question. Somebody pass out? Okay. Oh, I have it on my... I don't have to do it that way. Oh, well. Okay. Gonna start. Come on. Statement of cash flows. What approach? Direct or indirect? Indirect. They started with net income. They added depreciation, didn't they? And then they added share-based compensation expense. Now, since I guess you're not staring at accounting all weekend like I would have thought, come over. And do you remember when we talked about stock options and we debited compensation expense for the value of the stock options and we credited the stockholders' equity? Did any cash go out as a result of this expense? Did any cash go out as a result of this expense? No. So this stock-based compensation, and the reason I'm focusing in on this one line item here on Apple statement of cash flows is a what? 9 in the millions add. So if you take 9036, that the number up there, 9036, whatever? 38. Okay, you take 9038, and then you look at the income statement and you look at their operating expenses, and I'm just going to tease out the selling and administrative expense. Selling and administrative expenses, somebody read me that number, 25 what? What? 0.94. And what do you get as a result of that fraction as a percentage? I'm asking you. 9038 divided by 25094 equals 0.36. 36%. So Apple gets to add back 36% of their selling and administrative expenses. They get to add back 36% of that to get cash provided by operations. That's a pretty nice little expense. It's taking up a lot of expenses, reducing that income, but it's not using up any cash, is it? And I see that on that statement of cash flows by looking at that add back. That's a big one, isn't it? What I just did there is what they call vertical analysis. Vertical analysis says, hey, within the financial statements, can we look and see how a company is performing against itself? We could also do ratio analysis where we might compare this ratio to other companies to see how Apple compares to, say, Microsoft in this area. When we do horizontal analysis, we will be looking across the years to see how amounts change. So, when we reconvene on Wednesday, I will start with that formal discussion in Chapter 13, where we're going to start talking about some different analysis, horizontal, vertical, ratio analysis. After that, guys, we will be done with the discussion of the external reporting and start to focus on some of the internal reports that a company would use for their day-to-day operations. Question?
That ratio again and say why it's good, like, does it give, like, where does this 9,000 go to and why is 36% because it's good?
I mean, it looks close to me because 9 would be about 9 times 3 is 27. Somebody want to verify that? 9038 divided by 25.
The numbers, like, what does that ratio mean in terms of this performance? And why 36% is a good number?
Well, first of all, let's start with why 36%. It's 36% because my understanding by the calculation that was done here in class is that 9,038 divided by 25,094 equals 36%. Are we all in agreement there? Okay. And what I'm telling you is of the total selling and administrative expenses for the first year in this analysis, and maybe I should have done the second year. I might be mixing up years. I don't know. But just if I use that one, of the total selling and administrative expense, 9,000 of that was made up of a non-cash expense. So even though net income is going down as a result of this expense, it's not using any cash. That's cash that's available to do what? Pay dividends, make further investment in properly planned equipment if they want to.
What I meant was that why other sources are better than cash to make up for the expenses? Like maybe they're selling like important assets, or is it always a good thing that this ratio is pretty low?
I wouldn't call that a low ratio. I'd call that a high ratio. I'd say that over a third of their expenses that they're reporting for their selling administrative expense isn't using any cash. Do you want a company to hemorrhage cash to pay their expenses? Would you like a company to dump a bunch of cash to pay expenses? Or would you like them to find some other way to pay their expenses? That's what that's telling you. That's telling you that, hey, they're paying an expense. They're showing an expense. It's an accounting requirement that they show an expense for that, because remember we talked about how FASB requires, and it's probably correct that there is some, there was a service that was provided and the future economic benefit of that service has expired. So yeah, that should be an expense, but it didn't use any cash. I find that interesting on a bad day. I'd certainly want to dig a little bit more. Now, somebody might say, well, yeah, but now you've issued some stock and maybe you could have got more money in for that stock. I think somebody had asked that question here when Danny was here. And my question to that question would be, then why do they do it? Why do they do it? I mean, I don't think Tim Cook's sitting up there smoking crack. I mean, I'm thinking, when they decide to do these kind of things, they're thinking, this is a good thing. Now, some of that money is going to high levels of the entity, by the way. It's not just employees that are getting that money. So the people that agree and decide to do this and vote to do this are probably the ones getting the most money out of this whole little deal. That's probably why they weren't too much in favor of having this report on the financial statements as explicitly as it was, but that's just me talking. And 8 million other people. Question. Okay, guys, you should know. Question?
Which one was the first number again? The 9,038. What's that one from?
Well, let's make sure I'm comparing apples to apples. So this was for 2022. Okay, so I picked up the right number, 25,094. And then I scrolled down to the statement of cash flows. And I'm just trying to show you, one of the things that the statement of cash flows reveals in that of their total selling and administrative expenses, they got to add 9,038 back to net income to figure out cash provided by operations. I mean, you can see it right here. Look, you take that and the depreciation and look at the difference between their net income and their cash provided by operations. I mean, that might be another vertical analysis you might like to look at. What's the difference? So if you took 122,151 and subtracted off 99,803 and took that difference and then divided it by the 122,151, you would sit there and see that they're adding back 20-something% of their difference between net income and cash provided by operations, and the big drivers there are depreciation expense and stock-based compensation. Anybody got a number for me? 122,151 minus 99,803 divided by, am I saying these numbers and no one's putting them in a calculator for me? Otherwise, because I'm going to stop if that's the case. Because I don't like to talk for no reason. Well, I do like to talk for no reason, but I'm usually drunk when I'm doing that. 122,151 minus 99,803 equals, divided by 99,803. 99,803.
22.3%.
So they're generating 22% more in cash provided by operations than their net income. I mean, no wonder Apple's sitting on all that cash. And so forth. Play jazz with it. Okay, guys? All right, we will see you on Wednesday. We'll do some more of this ratio analysis stuff and whatnot, vertical, horizontal analysis on Wednesday, and then we'll get into the internal accounting discussions.